Hey gang, what's happening? We are live, so it's good to see you guys tonight. We are, oh gosh, I guess we are here in Alabama. It is not terribly chilly here, but it has been up until this point. My understanding is we got some more frigid weather coming our way. We did get some snow this past week, and which is unusual for us. We usually get maybe one or two snows a year, and this one, gosh, we got maybe 5 or 6 inches of snow. So it was quite the winter wonderland here. Um, so anyway, I just want to kind of see who all's here. I think tonight what we'll do is I was looking at my portfolio, kind of, every year I go through just a process where I look at what I'm doing and think about things that I should change. But as I was doing that, I was looking at the purpose for my portfolio, the strategy, and then the what I call critical success factors for the portfolio. So I thought, wow, why not share that with you guys? And if you like that stuff, that's good. If you don't, then just throw it away. It didn't cost you anything. So at least I can share with you what I do, what I look at, and how, from a high level, 50,000 foot perspective, I look at my portfolio. So we'll do that. We're also going to take a look at some of the news, because I think there's some interesting things in there. And then there's also some questions for Kevin. And I didn't look at some of these, so we'll just kind of do it fresh and off the cuff. So if that sounds good to you guys, then that's where we'll get started. But first of all, like I always like to do, I know my buddy Russ gives me some shade about this, but I like to see who all's here, and just to say hello. So if you are watching the program, just shoot me a note, say hello or something like that. I'd love to know that you're here. So we have Michael Swami. He says, just curious what the bees are doing in response to the frigid temperatures. And that's a great question, Michael, because it's a stress on them, right? And so here in Alabama, it's not as frigid as it would be up in Canada, per se. But what the bees are actually doing in the hive, if you want to think about the hive is basically a couple of boxes, and they have frames and comb inside those boxes. And in that comb are places for the queen to lay eggs, but there's also honey in those hives. And so, I was talking to a gentleman the other day, and he didn't realize that bees ate honey in the winter, because I was saying that, for me to gather honey, I need to make sure that I leave them enough for the winter. And he's like, why is that? And I was like, well, they eat it. That's why they make it, right? So it's their way of surviving through the winter. And so if I take too much of their honey, then they could starve to death, and that's not a good thing. So what they're doing right now is they start really in early winter in the bottom of the hive, and they basically work their way up as a ball. Now, if the temperatures go above, let's say 55, 58 degrees, they will actually get out and fly around, take their what they call a cleansing flight, and basically they poop. Uh, and so so they'll go out and fly around, but they'll come back, and the temperatures will drop back down again, and they will do what's called cluster. They will cluster together, and those bees will vibrate and create heat to keep them warm. Now, what that means is that vibration actually takes energy, and so they need their food to be able to survive. So they will actually eat their honey stores as they work up the hive throughout the winter. And hopefully by the time they reach the top of the hive, there are flowers blooming in the spring, and they can go out and get some more honey. If not, then, I have to kind of kick in and throw some things in there that they could possibly eat. So that's kind of what they're doing. Hopefully that's enough detail. I did have a hive die out, and there's no real explanation for it. There was plenty of honey in the hive. There was nothing that I could tell wrong in the hive, but all of the bees died. even the queen. So everybody, I went out there, one day, and they were fine. And then about 3 or 4 days later, I went back, and they were dead. They were just all dead. So it's called a dead out, and that's what it happens sometimes, and people don't understand why. So anyway, that was a bit frustrating because that was a hive that has some honey that I love. It comes off my muscadine vines, and it tastes so good. So, but anyway, that's what the bees are doing. I still have, a few hives, and so everything's going well with them. And the chickens are doing fine. They did not like the snow at all. If any of you know about chickens, you know that they regulate their body temperature through their feet, and so they do not like walking on snow and ice because it freezes their feet and it causes their entire core temperature to drop. So they don't like that. So they stayed in the coop, which I don't blame them. I would have too. So anyway, that's kind of what's going on here at the farm. Nothing is growing except chickens, and they've slowed down a lot. We didn't get any eggs today. We have 10 chickens and 0 eggs today. But we're typically getting 1 to 2 eggs a day, and as the amount of daylight hours reduces, chickens by nature, just their normal cycle, they need a lot of light, a lot of sunlight to lay eggs. And so, our chickens are slowing down, which is the normal thing in the wintertime. Some people will put a light inside the coop to kind of fake them out. But I don't do that. I just want them to be who they are. I just want them to be chickens. And if they need to slow down in the wintertime, let's let them slow down in the wintertime. I'm okay with that. So there you go. That's kind of the update on the farm, Michael. So hopefully that's helpful. Hey, John Jay's here. Good to have you, man. Glad you are joining this show tonight. Colin Schultz, good evening to you, my friend. We have Rust Moments here. Yo, right back at you. Let's see. Pat's here. Pat's got good internet this winter, which is really good. So it's good to have you, buddy. Billy Johnson, we're here for the matinee show. Yeah, this is a matinee, which is usually a really cheap entry price. So, it's so cheap, it's almost free, right? Fast Eddie, good to see you, man. The hat has arrived. Yes, it has. I love this hat. I actually wore it the other day. It was really cold with the snow and stuff, so I wore my hat. It felt really good. Steve's here. Good to see you, Steve. El Dynamico, Mr. Antonio is here on the program. So Billy is over in the Philippines, and he has to say it's around 70 to 75, a little chilly. Yeah, well, it's a lot chillier than that here. I think we're supposed to get down, below freezing tonight. So, Jim, welcome, man. You're here. We got Slammer 6789. Al Dynamica's got a great question. How do we know how much honey to take? And I think it really boils down to knowing how much honey we should leave. And my approach, and probably every beekeeper is different, but my approach is to leave at least 1 honey super on top, meaning that they've got what they call the brood chambers below. That's where the queen lays her eggs. There is some honey in there. There's some pollen in there. But the chambers that are higher are strictly honey usually, and therefore I like to leave 1 of those for them for the winter. So that's my approach, and which is really it's probably about 30 pounds of honey. So one honey super, 1 medium size honey super is probably about 30 pounds of honey, plus whatever's down in the brood chamber. So. That's typically enough. So hopefully that helps. I could go into a lot of detail, but I'm not sure you guys want all of that. So Fast Eddie, male bees. Actually, male bees are called drones, And those drones, first of all, this is a really interesting point. Male bees, the drones, cannot sting. They have no stinger. They are bigger than the female bees, and their only role in life, is to mate with the queen. So they will, when they get of age, they fly off. They find some, cluster of male bees, way up in the sky, and then when the queen is ready to be mated, she will fly and look for these cluster of male bees, and that's how they mate. When a male bee mates with the queen, they die almost immediately. So the queen then comes back to the hive, hopefully doesn't get eaten by a bird or something like that, comes back to the hive and is ready then to lay eggs. The male bee is laying on the ground somewhere. So anyway, yeah, male bees really don't have much of a role. They do get fed by the female bees, what they call the worker bees, during the summer months. But then when it gets time for brass tacks, as they say, when it gets time for brass tacks, and they look at the worker bees are looking at this winter coming up, they're looking at the stores they have of honey, and they're saying, "You boys, I gotta go." So they will actually kick the male bees out, and when it's time for male bees, they will actually have the queen lay eggs for male bees starting next year. So that's probably more than you wanted, but hey, it's all fun. And then we have Honeybee. Welcome to the program. Hi, y'all. I love that. I was going to actually open the program with that. So, hi, y'all. I'm trying to get my Southern accent going here because I'm not originally from Alabama, but gotta, when in Alabama, do as the Alabamians. And how about those Buckeyes, right? That's where I got my MBA, is the Ohio State University. So they have been doing well. So since I live in Alabama, I posted on my Facebook account the other night. It didn't get a warm reception, but as everybody knows, the Alabama Crimson Tide, they'll say "Roll Tide." So I said, "Can I get a Roll Buckeyes?" But it didn't go over very well. So anyway. Let's see. Yeah, me too, Michael. I'm fascinated by honeybees as well. They are a marvel. I mean, it is incredible what they do. As a matter of fact, they are the only bug that produces something that humans eat. How about that? Yeah, think about that for a little while. How many movies did you need to start your colony? How many movies? Oh, how many bees? I got you. Let's say for each hive, I will buy a package. So if I'm wanting to start a new hive, and I know this is a stock program, but sometimes it's just fun to talk about bees. So when I start a new hive, I will buy a package of bees. That package of bees includes a mated queen and 3 pounds of bees. Now, that doesn't sound like a lot, right? But 3 pounds of bees is about 10 to 12,000 bees. So if I start 2 hives at the same time, I will actually introduce 20 to 24,000 bees onto the farm. And so that's a lot of bees, but it takes a lot. So, and bees only live now in the wintertime, it's different, but typically, from spring to fall, a bee will only live about 45 days. So that's why the queen is constantly laying eggs, because they need to have more bees. So, yeah, only one if it's the right movie. Hey, Gentry's in the house. Good to see you. Yeah, I love the cowboy hat on the emoji. So that's awesome. John J, can you trick them and put sugar water instead of honey and wrap them off? Yeah, so that is the way to feed them if they don't have enough honey. Is in the spring, summer, fall is sugar water. You don't want to have water in the hive in the winter because it has a tendency to cool off the hive. So the bees are in there clustering, trying to keep it warm, and then all of a sudden you're introducing water, which will absorb any heat that they're trying to put out. So you want to try not to introduce any water into the hive. So we have what's called fondant, where you basically cook sugar, and it gets more, I guess, hardened. So that's kind of the way we do that. But yeah, sugar water is actually a very good way to feed bees. Hey, we got Bernard. Welcome to the program. Let's see. Michael says lots of male bees over New Jersey this fall. Yeah, that's right. Those male bees had a lot of lights on them too. Those are called drones as well. I get it, man. That's good stuff. Uh, take the good honey and replace it with Safeway honey. Yeah, I have read and seen YouTube videos about because one of the things I do is, if I've got like a bucket of honey, you can't ever get all the honey out of a bucket. It's just real sticky, right? So I will put that out and so any residual that's left in buckets or whatever, I'll put that out and let the bees feed on that. They will get it and they'll take it back to their hive, right? But I've heard if you get some store-bought honey, especially if it originates from overseas, it could be made up of some kind of corn syrup and things like that, and it actually could kill your bees. So I tend to stay away from store-bought honey when I feed my bees, but I don't mind feeding them back their own honey. I think that's that's a very nice thing to do. El Dynamico says he wishes he was a bee. Yeah, until it gets to be winter, man, and then it's just like, what do you do? It's like really boring to sit around and vibrate all day. Let's see, what else do we have here? I don't know, Jim. You're just not right, man. I'm not sure. So, but I think you're right. Honey Nut Cheerio. That's pretty much it for the male bee. So that's great. Honeybees from Alabama too. That's awesome. From Huntsville. So we're about an hour apart. So yeah, that's great. I'm glad to find a fellow Alabamian here in the program. El Dynamico lived in Georgia for 3 years, and he could have fooled me. All right, so let's get started here. Let's see, we've got one other here. I got my buddy Ryan Williams in the program. It's good to see you, Ryan, and we're going to get started here. So let's what do we want to start? Let's start with what I actually put on the program, and that is we're going to look at how I look at my portfolio. I mean, just from a high level, right? 50,000 foot level. I forgot to share it. So let's do this. We'll share that. Boom. Can you see that? Awesome. So this is the Wealth Circuit Investing Portfolio Strategy. And, if you don't spend time thinking about the strategy of your portfolio, thinking about it from a 50,000 foot level, then at least what I found is that I tended to make decisions when I'm looking at the nuts and bolts, daily decisions, market movements, stock movements. I really kind of got lost, and I followed the crowd. I followed, emotion, and so I really needed to step back and say, what's the purpose of my portfolio? What is the strategy that I'm going to use to make money in the stock market? And then what are the things that are critical for success of the portfolio? So I'm going to share all of that with you guys today. So you guys ready? So first of all, here's the purpose of the portfolio. And those of you who don't know me very well may not know that I actually have 2 master's degrees. One is in business administration. I passed the CPA exam about 100 years ago. And so I've got an MBA, I passed the CPA exam, and had a lot of accounting experience. And that's where my love for investing comes from, just the love of business and strategy and stuff like that. But my other master's degree is in biblical studies. And so I unashamedly base the purpose of my portfolio off of scripture. So you can see that here. I provide, or the portfolio is designed, its purpose is to provide income for living expenses as well as giving opportunities. So I want to focus the income from the portfolio on living and giving. Those are the two things, while simultaneously growing the portfolio to provide a legacy for future generations. So I don't not only want to live and give, but I also want to provide, for the future, for my future generations, as they say. And Dave Ramsey, if you guys, some of you guys may like him, some of you guys may not. But one of the things that he says, which really resonates with me, is that when you come from a family who wasn't very good at managing money and you change that dynamic, it's like you're changing your family tree. And that's kind of what we've done here. I come from a family that didn't have a lot. As a matter of fact, I paid for the funeral services for my mom because she just didn't have anything. And then my dad happened to have a small life insurance policy that basically paid for his funeral services. And that was pretty much it. So, coming from that background, it was important for me to have a purpose, right? So that's the purpose of the portfolio. The strategy is pretty simple. I like to keep these things as simple as I can. My strategy is to build diversified holdings in companies that have long-term competitive advantages and provide overall expected total returns of at least 8% per year. Now, what I could have picked a bigger number, but I don't need a bigger number. I just need 8% per year. I need because if I pick a bigger number, it's going to drive me to pick stocks that may have more risk than I'm willing to take on. So 8% is all I need. So I'm focused on 8%. I try to get more than that. It's not like I get to 8% and I sell everything off and wait for the new year to begin. But 8% is what I look for. So no. So these are then kind of delving down. Um, how do I measure the success of the portfolio? How do I what things do need to happen in the portfolio for it to be successful? That might be a better way to say that. So first of all, and I'll go through these really quickly, uh, using a due diligence process. And mine happens to be a 5 pillar approach. I look at a company's strategy, its management team, its financials, its valuation, its capital allocation. I've talked about that, many times, but that's, number one on the list. Number two is unbiased research and decisive investing. I find sometimes I fall in love with a stock. I've fallen in love with a couple of stocks before, and they have turned out to be horrible investments. But I fell in love with them, and so when I say unbiased, I need to not fall in love with stocks. I need to be unbiased in that process. My portfolio, I want it to be somewhere between 15 and 30 holdings. Right now it's 25. I think that's a reasonable number. And I invest up to 30% of the portfolio in an S&P 500 ETF. And I do that because that's really money that I see, kind of legacy money. And there's no reason for me to pull back the risk on that. I just let that risk ride, let it run with the S&P 500, and it does its thing. The rest of the portfolio I use to live and give, and so that's the way I manage it. Then staying abreast of current issues and news for investments, benchmarking portfolio performance to identify improvements. It's important, I think, that we benchmark, but I tend now to focus my benchmarking on longer term instead of day by day. I do, obviously track it day by day, but I tend to focus more on the longer term. Let's see. I'll just kind of lump the next three together. I look at, stocks that are normal weight for me are somewhere between 2 and 4% of the portfolio. If I want to be overweight on a stock, I can let it go up to about 10%, but that's about it. if I'm getting into a new stock or if I'm getting out of a stock, I can underweight it, but there's no stock in my portfolio that I want to be below 1%. So if the stock tanks and it goes below 1% of the portfolio, then I'll either add or get out of it, because less than 1% really doesn't move the needle. And so therefore I just don't want to have it. BDCs, business development companies, and REITs. I want those held, if I have any, I want those held in tax advantage accounts. And stocks, regardless of yield, this is important. Stocks, regardless of yield, must have some potential for both dividend and capital growth. I don't want to buy stocks who are just income stocks. So income stocks, and their price is depreciating, doesn't do me any good. I want to have not only income, but I want to have growth as well. So, and dividends received in taxable account are available for living expenses or reinvestment. So I can do either. So if I need the money, I can pull it out and live on it or give it, or if I want to, I can reinvest it and move on with life. So that's my purpose. That's the portfolio's purpose. That is the portfolio's strategy, and then the success factors for the portfolio. So hopefully that's helpful. If you got any questions on that, we can hit that up. What do you guys look at? Is there anything that maybe you guys do that I don't have on my list? So I'm kind of looking for some feedback there as well. Let's see. Fast Eddie, we're still on the bees. Cooked sugar is not called caramel. Caramel also has cream in it. So just cooked sugar is basically sugar water. That's what it is. But if you want to caramelize it and add some cream to it, you can make caramel. So that is one of the useless pieces of information I have in my head. All right, let's see. Rust bought Zoetis today. That's great. Great job, man. Let's see. Yeah, that the purpose, I think, and the purpose didn't come first. The purpose really came later, after I had made a lot of mistakes and after I had, fallen prey to a few things. It really it kind of morphed, and so that's where it came from. So yeah, thanks for that feedback, man. So we're hopping back and forth between stocks and bees now. This is awesome. Joking on ripping the bees. Wonder if different flowers will give you different quality of honey. Definitely gives a different taste and color for the honey, which is really wild. Some honey will be really dark. Some honey will be very light, and it just depends on the flora that's available for the bees. So that's a fun fact. Yeah, amen to the purpose. Hey, I love that, man. How about J&J? I'll put that on my little list here because we're going to look at some stocks here in a little bit. There was some put in the questions for Kevin, so I want to kind of hit some of those. We won't go deep into any of them, but I'm going to add J&J to my list here. 8% seems very reasonable, solid return that you shouldn't have to reach for. Yeah, I think that's right, Ryan. And, I think it's something that I could do consistently year in and year out. I showed last broadcast what the returns were. Maybe I can pull it up real fast and show you. Give me just a second here. Yeah, here we go. I'll share this with you, Ryan, and everybody. Here we go. So let me back up. There we go. So you can see that the S&P 500 2022 was down 18.1%. It was up 26.3 and then 23%. My portfolio was up 1.1% in 22 and up 12.4 and up 16 in 2024. Then if you take those numbers and if I put $10,000 at the beginning of that period in the S&P 500, that $10,000 at the beginning of 2022, $10,000. At the end of 24, that $10,000 is worth $12,723. If I put it in the wealth circuit portfolio, it's actually $13,190. And why is that? It's because the stock market doesn't always go up. And so yeah, I'm not hitting the peaks that the stock market is, but I'm also not catching the dips in bear markets like the one that we're in right now. So just thought I would yeah, share that. Hopefully that's helpful. Let's see. Oh, we got Russ. My buddy Russ is here. Riddle me this. Why are 23 watching and only 5 likes? That's a great question. Why doesn't everybody respond to Russ on that? That's good stuff. Let's see. Yeah, the whole dividend community is here. That's awesome. Yeah, we got 29, which is a good night for me. So ugly market today, but my portfolio was up almost 1%. So I had a great day actually in the market. Have I heard of Mad Honey? No, I've not. I've heard of Hot Honey, but I've not heard of Mad Honey. I've heard of Mad Money with Jim Cramer, but not Mad Honey. El Dynamico says next month makes exactly 2 years that I have been investing, and I so far have 6 holdings. Needless to say, my highest holding is so far 20% of my portfolio. Yeah, and El Dynamico, it just depends on how big the portfolio is. A portfolio that is the size that I run is, I think 20% is probably too much for me. But each to his own, said the lady she kissed the cow, right? So 20% works for you. Hey, I'm all in, man. It's all good. Oh, we got some lessons from Russ here. I was listening to William Priest on We Study Billionaires, and he mentioned his book, Free Cash Flow and Shareholder Yield. Did anyone read it? I have not. I don't know that I've even heard of William Priest. So maybe I should look him up. I will do that. But I have not heard of him, nor have I read that book. So yeah, 9 or 10 holdings. I think that's fine. And I think from a diversification perspective, I think anything over 15 stocks, you don't really get any appreciable diversification benefit as long as your 15 stocks are diversified. You're going to have market risk regardless. You cannot diversify away market risk. You can diversify individual stock risk. And so once you hit about 15 stocks, that's pretty much there. So 9 or 10, that sounds pretty reasonable. Let's see. So Russ is thinking that 10 to 12 is his first goal, and I want to keep the individual stocks to more than 15%, to no more than 15% of the investable net worth. Okay. Well, that works too, man. Let's see. Okay. I tell you, here, I'll read a few more of these. HWM, I don't even know what that is. So I'm going to put that with the J&J, HWM, and we'll look at that here in a few minutes. Let's see. Good point, Kevin. It's easy to forget about the drawdowns. Yeah, exactly. Especially when things have been so good in recent times. Yeah, I mean, you can, at least for me, it's easy to ride the emotion, right? And sometimes you got to stop and think about where you are. I don't run my portfolio today like I did when I was 25, for instance. Let's see. Yeah, no, that's a great point, Rust. Let your runners run sometimes, and I've got some runners, and so I'm letting them run. There's My model told me to sell Parker Hannifin, but I did not sell Parker Hannifin. I've held on to it. We'll see if that's a good decision or not. But sometimes you just got to let the runners run. That's a great point. Shareholder yield is an underrated factor with respect to return. Yeah, I think that's right. And by shareholder yield, um, oh, underappreciated. Yeah, I get that. Yeah, no, I think that's exactly right, Michael. Yeah, yeah, and shareholder yield is the dividend plus buybacks. Yeah, got it. Okay, so let's do this. I'm gonna go to where am I gonna go now? I think I will go to the Discord, and let's look at a couple of things here. So there, I've got a channel in here called Questions for Kevin, and there's been several questions, and so I thought what I would do is actually, hit those here. I didn't really prepare anything for this. I'll just give you my thoughts on it. So one of them, and I don't know, can I make this bigger? I don't think so. It's not letting me. So anyway, I'll just read it, but it basically says this is from N. Kiter, and he says thoughts on AWK. I think that's American Water Works. I started reading about it, went through some cybersecurity breach. The price reacted accordingly. Yeah, one of the things about these water companies, I think I had AWR at one time. But yeah, one of the things about these water companies is there was a time when there was this thought that because water was a non-renewable resource, that people that we should invest in these water companies, and I think water companies are fine, but they are utilities, just like gas utilities, just like electric utilities. Their business model is exactly the same. So I don't know that there's any real value to. I don't think we need to overpay for these water companies, but it sounds like these water companies, especially this one, maybe they've had a cybersecurity breach. Sounds like it's probably running a little bit, at least at market value or fair value, and so there's nothing wrong with them at all. But I would want to know kind of what their regulatory stance is. What how are they getting paid, and do they have a favorable regulatory environment in the states that they operate? So that's what I would want to know. I used to own AWR. I think my buddy Ryan used to own that too. And I know I got out of it. I don't know, Ryan, if you did. If you can let me know if you're still around, let me know. Um, but it might be time to get back into them. I don't know. I can take a look at here. Let's do this real quick. Let's go into fast graphs. I'll look at there we go. AW. They changed our fast graphs a little bit. So there we go. American States Water. That's what it is. Yeah, it looks like it's not a bad. Looks like it's not a bad price, man. Looks like it's certainly in fair value. So I wouldn't be opposed to that at all. The yield is 2.61%. So, it's reasonable, but it is a utility. So let's think of them as utilities. All right. So cool. Now let's move on. Let's move back to the questions. I'm going to try to fly through these. Let's see. Yo, Kevin, what's the most useful subscription you pay for that you'd recommend? And I think I hit this in the Discord, but I'm going to answer it again here because I think it's really important. So here's the ones that I actually use. And this is what I use in not only for the live stream, but just every day. I'm looking at Simply Safe Dividends. I think that one is really good, provides a lot of information all in one spot. If I had one that I would pay for, it would be Simply Safe Dividends. If I had two that I would pay for, it would be Morningstar, and Morningstar has some good valuation and also technical write-ups on the stocks that they cover. They don't do it for every stock, but the stocks that they cover. Then the third one is Tip Ranks. I dropped my pen, so if I disappear, it's because I'm picking my pen up. The Tip Ranks gives a lot of information, but what I really like about Tip Ranks is the way it handles and organizes the analyst perspective and prices, expected prices for stocks. So that's good. And then yeah, you can see here the portfolio went up 0.95% today. So that was a great day. And then lastly, fast graphs. I there's several levels of fast graphs, and I used to have the big one that had everything in it, and then I backed off, and now I'm in the medium one. And I to be honest, I don't go in there a lot anymore, and so I'm wondering if I still need fast graphs or not. We'll see. I've still got some time. These are annual subscriptions, so when it comes time to renew, I'll have to give that some thought. But if I had to pick number one, two, three, four, it would be Simply Safe, Morningstar, Tip Ranks, and then Fast Graphs. So those are my thoughts. So good question, my friend. Let's see. Ex-dividend death. And I answered this. There was a question about insurance companies, specifically Chubb. And so I answered that in the finance thing. So, but then there was one from my buddy, Mr. Income. And I don't know if he's in here tonight or not, but I wanted to give a few thoughts on Texas Roadhouse. He says, at your convenience, can you please give Texas Roadhouse a few minute look, specifically their financial strength and safety? So he's got some other thoughts there, but let's take a look at that. Let's take a look at Texas Roadhouse, because I know that there's a lot of my buddies that love Texas Roadhouse, and it's a good stock. So let's do this. Let's look at it first in Simply Safe Dividends. And then before we get out of here, I want to show you my spreadsheet on it, because it's one of the 90 some odd stocks that I track. And so Texas Roadhouse, let's kind of take a look at some of just the financial details, because that's what my buddy Mr. Income wanted. The earnings payout ratio is looking really good. It's in the 40% now. Next 12 months looking at 34%. That's fantastic. The free cash flow payout ratio looks great. Earnings per share is up and to the right. That's what we want. Free cash flow is very similar. Sales growth is very consistent. They're buying back a few shares, but not a ton. But if they're growing, I don't know that we want them buying back a lot of shares. Look at their sales here, just continuing up and to the right. With the return on the invested capital, which is the one that I like, it is in the 18 to 21% range, which is really good. I love that it's got that high of a return on invested capital. Net debt to capital is 33%, so that's very reasonable. And the interest coverage ratio is above 8. As a matter of fact, it's 2,600. So I think it's got plenty of room to grow there. So just from a financial perspective, I don't see any issues with Texas Roadhouse at all. Morningstar they've got a quant rating on them, but they've got a fair value of about $136. Not sure I put a lot of stock in that, but they do believe it's overvalued. So, and where are we going here? We're going to look at, this is Tip Ranks, and well, I don't want that. I want to look at Texas Roadhouse. So yeah, Texas Roadhouse analysts believe that there's about an 8% upside to Texas Roadhouse. So this is a good segue into my spreadsheet. So I'll put that on here. I can make this bigger. I know that. And so here's Texas Roadhouse. Matter of fact, what I'll do is I will get rid of everything except Texas Roadhouse so that it's easier to see. There we go. There's Texas Roadhouse. You can see that I have it on the watch list. I don't own any of it. I show it with a potential return of 6% over the next year. Analysts are saying 10% overall. That's total return. And it's got a narrow moat according to Morningstar. And according to Morningstar, it's 133% of its fair value. Return on invested capital is really good with a high level of uncertainty and an 80 dividend safety rating with a 1.4% dividend yield. So, it's a reasonable stock. It's not high on my list because it's just not, anything can happen, right? But based on what we know, it doesn't have a significant potential return for me. So I'm not investing in Texas Roadhouse at the moment. You can see it's line 73. So it's the 72nd. It's number 72 in my list of 94, I think, stocks that I track. So it's not high on my list for stocks. I do like the company. I like its financials. There's nothing wrong with it. It's just not high on my list of stocks. So hopefully that's helpful, Mr. Income. Okay, let's get back to what you guys have on your mind. Yeah. Okay. Try to pick up here. Hey, Michael Anthony's with us. Good to see you, man. Major support 10.26 MFA. What is MFA? I don't know. Let me look that up real quick. MFA Financial. So yeah, according to analysts, it's got a 27% upside. So might be worth taking a look at, but I'm not familiar with it at all. So I would need to do a little research on that. Let's see. AWR got 71 years of dividend growth. When they hit 75, will we call them a dividend legend? Yeah, I don't know. They're going to have to come up with something, right? So, there were some other ones too. Let's take a look at this. SJW is a water company I own, sold AWK to get into it. Okay, that's good to know. Yeah, so Ryan does not own AWR anymore. That's good to know. I'm not sure on the current valuation, but I remember it being a steady grower. Yeah, I agree with that. Yeah, so let's look at a couple of these stocks. I'm going to go ahead and share this again. So one of them was J&J. So Johnson & Johnson. Johnson & Johnson is in my portfolio. Let's just take a look at it in here. See if that would be kind of fun. Oops. We'll just look at it by itself. Johnson and Johnson. There we go. So you can see it's number 37 in my list. It has a potential return of 11%. Analysts say that it's got a potential return of 20%. So it's definitely worthwhile. It is 2.3% of the portfolio. I had backed it down. It was 6 to 7%. I backed it down to about 2.5%, and then all of a sudden it began to decline. That was when it was like in the 170s, right? So I backed it down to 2.5%. It's now 144, and so now it's 2.3% of the portfolio just because it's come down in value. 3.4% yield. So let's take a look at some of the things here. Everybody knows it's got a wide moat. It is it's undervalued according to Morningstar by about 12%. That's not significant, but it's better than being overvalued. return on invested capital of 14%, low uncertainty rating, and a dividend safety rating of 99. They're one of the two companies that have a 99. Not, no, I'm sorry, I can't say that. It's the triple A credit rating. So forget I said that. So dividend safety rating of 99 and dividend yield 3.4%. So I think it was Jim that was asking about Johnson and Johnson. I like Johnson and Johnson from a long term perspective. It is actually the only um, uh, pharma that I own, and I just like it because of its consistency. It's not going to knock the world on fire, light the world on fire. It's kind of a shock absorber, to be honest. And so, when the price goes down like this, it makes me kind of want to add some shares, but I'm not at this point because I don't have a ton of free cash. So, plus it's not real high on my list of fun stocks. So it's number 36 out of my stock list. So let's see. The other one was HWM. I do not track HWM, so we're going to have to go over to here and let's take a look at HWM. Howmet Aerospace. It's about a 13% upside according to analysts. Is it even a dividend stock? HWR. HWM. Sorry. Howmet Aerospace. Yeah, they don't even pay a dividend. So, it's their sales are their shares outstanding are pretty, I guess they're coming down a bit. Sales took a big dip in 18 and they've been not very good. Now, if I look at the return on invested capital, it is climbing. And at 19%, it's something that would be reasonable. Back here at 8 and 4%, probably not. Net debt to capital is going down, so they're paying down their debt. That's good. Their interest coverage ratio is just a little short of what I like. I like to see an 8 or better. It's 7.73. So, yeah, I don't know. HWM doesn't cause me to get too excited. So, hopefully that's helpful. All right, so those are the stocks I promised that I would look at. Let's see. Let's see what else you guys are doing. Has anybody looked at Motorola MSI? It's surprisingly a very solid looking company. I have not looked at them, Ryan. So let me take a quick peek. Yeah, 61 dividend safety. They've got roughly 1% dividend yield. Their dividend growth is 11% for the last year. That looks to be really good. Wow, look at that payout ratio. Very nice. Their latest dividend is 11% growth. Man, look at this. Their 5% is also 11%. Look, since 2012, it's just been a consistent dividend grower, which is really, really good. So we like that. We like that around here, as they say. We like that around here. Now, according to Simply Safe, it's overvalued, but we will check that out here in a second. Let's take a look at the earnings payout ratio. We've already said that's really good. Let's look at sales in billions. Their sales are growing. I wonder, now Motorola used to make cell phones. I don't know what they make anymore, but it must be good because their sales are growing. Return on invested capital, fantastic, man. 30 in the 30% range. That is fantastic. So yeah, I agree with you, Ryan. It looks like something that's worthwhile. Now, be careful on the debt. Their net debt to capital is 82%. So that means that they are either buying back a lot of shares. That could be it. They may be buying back a lot of shares and causing their equity balance to be lower. I don't know if I want to spend the time to explain that, but if a company buys back shares, it pays cash, so it credits their cash account, reduces their cash balance, and then it also debits their retained earnings or their equity. And what happens there is that it reduces the equity value. So if you look at liabilities versus equity, and you have a net debt to total capital is um, the total uh, either assets or liabilities, then it gives you a very low equity number, very high debt number. And so that could be what's going on here. That'd be the only concern I would have. They do have a good 10, almost 10 in their interest coverage ratio. So the only thing I would want to research, Ryan, is that net debt to capital piece. I think that would be, and I bet what we're going to find is that they've bought back a lot of shares. Let's see what these guys have to say. MSI. They do cover it. They give it a fair value of 460. It's currently trading around 456. So it's according to Morningstar, at least from a long-term perspective, it's fairly valued. So that's good. Let's see what TipRanks has to say about it. So yeah, I'm liking it so far. 15% upside. So that's reasonable. And then just for fun, let's see what our friends at Fast Graphs have to say. It's a little slow. There we go. Oh wow, Fast Graph says it's way overvalued. So it's got a 33 price earnings ratio. So I mean, everything, Ryan, that I'm seeing, yeah, it looks like a really good stock. You just have to get comfortable with the price. Um, Looks like the end of 23 would have been a great time to buy it. And, it might be one to kind of put on the watch list and see if it comes back down a little bit. I don't know why it's been driven up. I don't know enough about the business, but if there's something that's like really driving it, but if there is in fast graphs, it should pull into the forecast, and the forecast is not showing, any kind of like huge growth in earnings. So, if you got a stock price up here, it's going to take a long time at this slope for the earnings to catch up with where that stock price is right now. So I would put that on my watch list, and I would kind of hold and wait for a better entry point. That's I guess I think the company looks great. The numbers look great to me. It's just that the price looks to be a little bit elevated for everybody except for Morningstar. Morningstar says, "Hey, you're at fair value." So that's for whatever whatever you want to do with that. They do a lot with law enforcement, first responders. Okay, cool, cool. Michael says they do stuff with the NFL as well. Yeah, Christopher, I think J&J and Pepsi both are on sale. They both have their, any company that's on sale has an issue. It has some risk out there that shareholders are reacting to, and it's always important to understand what that risk is. For Pepsi, I think it has to do with the health of the products that they sell, and there's a lot of uncertainty around, the what's his name, Bobby Kennedy, that's going to come into that role. And, so anyway, but from a long-term perspective, it might be a great time to enter into Pepsi. That's what we do, is take risks, but we want to take risks that we understand. So, but I agree. I think J&J and Pepsi both are on sale, but they're on sale for a reason. We just have to understand that reason and decide whether we want to invest at this particular point. Let's see. What time is it? Oh man, we are almost at our hour. Uh, we catch something else here. Let's see. Steve wants to know if Dine Brands even gets an SSD rating. DIN loves IHOP. All right, let's see. Let's check it out. DIN. Dine Brands Global. It does not. It does have a yield of 7.8%. They just don't follow it. So it's unrated. Is it worthwhile? Well, so one of the things that I look for, and this is not everybody, right? This is just for me, but I look for a little more consistency in the dividends. So, in 2009, we understand why this happened with the great financial crisis, but they went to zero. Then they came, they came out in 2012 swinging. They swung for the fences. It's $3, went up to almost $4, and then back down in 2021 to almost nothing. And now it's back in the $2 range. That's a little too volatile for me, but you didn't ask that. You asked if it had an SSD rating, and they don't. They don't cover it. So yeah, that's a shame. They don't cover everything. So that's the only downside to it, is that they don't cover it all. But the upside to that is it's real people looking and assessing these stocks. It's not some quant rating out there that looks at every stock and looks at some key factors and goes from there. So let's see. Yeah, Pepsi and Hershey are both on sale. Hershey has its risks, as Rust says, and I do own Hershey, and I'm comfortable with those risks in the long run. Matter of fact, I may pick up some more Hershey. Who knows? But I got to find the money to do it with. I got to sell something. Yeah. So sorry, somebody else must ask about J&J, but Gemma owns it along with ABBV. What do I think of ADM, Archer Daniels Midland? I owned it actually about this time last year. They had some terrible time with their financial reporting, and it turned out to be a nothing burger. It was really just some internal, among their product lines. So, I did actually make some money on it, but it was not a stock that I wanted long term. I think it's a great company. I just don't tend to see them as, I think they're going to be very cyclical, and I think they're going to struggle, in times of plenty and in times of want. So it's not something that fits into my portfolio, but if that's something that you're into, I think ADM's a fine company to own. Otherwise, I wouldn't have invested in it at all. But it was a turnaround trade for me. So yeah, I like them, but just not for my portfolio. If that makes sense. Well, our buddy Russ here used to do work at the Motorola global headquarters until they tore it down and moved. So is that because the work that you did, Russ? Did they tear it down? No, just joking, man. Hey, I'm just joking. Let's see. Yeah, similar to what we'd find for companies like Starbucks, Yum, yeah, Domino's, and McDonald's. Yeah, they have, and also interestingly enough, companies like Lowe's will be that way as well. So it's kind of fun stuff. It's fun for us accountants to kind of think about. So, so don't look at Top Golf stock. Okay, I won't. uh, let's see. If buybacks are funded with debt, so this is a question from my buddy Russ. If buybacks are funded with debt instead, would that change the net debt to capital ratio too? Um, the answer is no. It would actually make it worse, because the entry to equity will still be made regardless of its financing, regardless of how they pay for it. If they pay for it with cash, then and they already have the cash on their books. Let's say they made a lot of money actually selling product, and they use that money to buy back shares, then it's cash and equity. If they borrow money to pay for it, then they will increase their debt to increase their cash. Then they will decrease their cash and decrease their equity. So now it's not just the debt compared to the lower equity, it's now higher debt compared to lower equity. So it's actually even worse. But great question. You got this thing. You're thinking correctly about how it works. Let's see here. We'll take a couple of more. We're about 5 minutes over now. But this is great. You guys are doing so good tonight. Let's see. So DIN is a no for you. I think that's correct. It's a no for me. It's I would say no. I don't think I own any restaurants. I own some French fries though. I own some Lamb Weston French fries. I haven't looked at that in a while. How's it been doing? Somebody help me out. Help a brother out, man. I need to find out what my French fries are doing. Because at some point I'm probably going to get out of that transaction. Lamb Weston. Lamb Weston. All right. It says 14%, so that's not terrible. It's a 26% discount to its fair value, but the reason for that is management is really poorly performing. So, so yeah, is it undervalued? Absolutely. But can they capture that value? I think only if they bring in a new management team. They just recently got rid of their CEO and put a new CEO in place. But the CEO, I think, was the COO of the company for like the last 10 years. So it's like there's no new thought. It's like, he's been with the company. So I'm thinking we're going to see more of the same there. So I wasn't real happy about that. Their dividend safety is a 67. So let's see, where are they price wise? $60. So that's horrible. That is horrible. Let's see. Let's see how I'm looking here. Down 12%, $6,900 on French fries. So yeah, some days you're the bug, some days you're the windshield, right? So anyway. Let's see. That was worth the price of admission. Yeah, I hope so, my friend. That's awesome. So Ryan wants to know if I have any serious opinions about Nike. I don't. I know that they brought their new CEO in, and I hope that he does well. I know that the other guy had pulled out of some markets, and so then you end up with, like, is it the Hoka, however you say it, shoe kind of came in and took some of that marketplace or market away from them. And so hopefully they can pull that back. I struggle with the and maybe this will be better with the new leadership, but I struggle with any company that has a political bent to it, like Disney, Nike. I can't think of any others off the top of my head, but I just struggle with that. I want a company that doesn't want to alienate half of its customer base. I'd rather a company not be political and just offer a good product at a reasonable price, and make something that people want to buy and just be happy with that. So that's just a personal thing, and nobody else probably shares that sentiment, but that's the way I kind of look at it. Let's see. So Russ says here, quality is rarely cheap. And I agree with that. But sometimes it is. And that's what we're looking for. is we're looking for. Um, we don't necessarily want it cheap, but we want it at a fair price, right? And if it's cheap, then we got to understand why it's cheap and be comfortable with that. So, hey, and Steven Rivera has joined us. Good evening to all. And that is the cue for me to kind of end the stream here. We have gone for almost an hour and 10 minutes. You guys are incredible. I really enjoy this. Gives me a lot of energy. It gives me a lot of, just this fires me up for the rest of the week. So I love being here with you guys. I'm going to get off of here now and go in and see. My wife just got home a few minutes ago, so I'm going to go see what's going on with her. And I will just look to see you guys next Monday night. And, I don't know what we're going to talk about, but we'll talk about something kind of fun. So, hey, we'll talk to you soon. See you guys.